All right. Thank you everyone to be on time. So, okay, lunchtime session. Honestly, I don't expect a lot of big crowd because this is the third session. So, based on the previous two sessions, the response has been pretty good. Managed to get someone to start investing. So I think it's a very good news for myself, lah. So, welcome again, everyone, and to join me on my second topic. In this circuit breaker period, I think everyone is hopefully still doing fine. We are in day 11, I think. All right, so let me just get started on today's program. So some of the charts might be a bit small. Use an iPad or desktop if possible, or you can actually pinch in to zoom to look at the charts, right? So let's look at the program for today. So, okay, disclaimer first, right? Okay, so as mentioned, all the information provided here is just for reference. The accuracy might not be up to date, so just take note of that. And of course, investments do have their own risk. So if you're looking to place any investments or make any, buy even for yourself, right, please do take note of the risk of losing certain capital. Okay, so just a quick disclaimer. Okay, so program for today's webinar. So basically the sum of the basics. So how do you start investing? What are some of the prerequisites? What to invest? So I'll just go through an overview of most of the common types of asset classes. At the same time, I'll go in detail about three common investments. And of course, we'll cover about how to understand the basics of the markets. What is the concept of this dollar cost averaging? Why does it help? In terms of doing investments. Of course, to do a quick summary, some key takeaways and action plan. So what can you do immediately that you can start your investing journey today, right? Okay, if there's time, then we'll do a quick Q&A. Okay, so how do you start investing? So looking at this wealth triangle over here, right? And as per anything, including financial planning, right? I think the base, the base and the foundation is the most important over here. So if you look at the base of the triangle over here, we are looking at wealth protection. So your risk management, insurance come into the picture. So step one to start investing over here, right, is of course we need to protect and secure your wealth from any unforeseen leakages due to accidents, health, hospitalization, or even death. Okay, because this actually, if this thing happen and you're not properly insured, it will actually lead to you prematurely liquidating any investments you have made prior to that. And of course, we need to protect the most important asset, which is yourself. You earn an active income, you make the financial decision for yourself and your family. I think you are the most important asset that we need to secure. So make sure that all your insurance policies are up to date. And of course, there's a need, right, to increase them from time to time, do a review, okay? And step two, of course, we are looking at to set up an emergency funds. So this is a rough gauge is about 6 to 9 months of your monthly expenses, be it for yourself or for your family. So in any unforeseen event, for example, a loss of job, or for example, there's this COVID situation currently that's happening, right? We are unable to tide through, there's a financial loss, for the next 6 to 9 months, you will be financially secure, all right? So this is very important. Okay, of course, step two is we're talking about wealth accumulation. That's why we are here today. So in terms of accumulating your wealth from investments or from savings, okay, so the step three of this whole process, of course, is to, once you have identified and set up your emergency fund, right, to any excess cash on top of that technically can be set aside for investments, right? Okay, the next step, which is very important as well, is to identify the purpose, and the time horizon for any particular investments made. For example, if you need to fund your child's education in about 20 years time, or if you're looking to upgrade your home, to a bigger house, in the next 3 to 5 years time. So this will actually determine what kind of investments you're going into, and of course the time horizon difference for different products, right? Okay, and of course getting yourself ready, your brokerage account has to be up, which takes about 3 to 4 weeks now. It's a bit slow, and a lot of people are investing, from what I hear from my broker. So the processing time is a little longer. But the good news is if you are looking into other investments such as unit trust or ETFs, right? We at GFA and myself, we are using this platform called iFast. The processing takes about a week. So more or less, you're still in time to catch this low market now, right? And of course, finally, we are talking about wealth distribution, which is estate planning. So this actually will be my next topic for next week. So the topic will be launched on this coming Sunday, 8 p.m. So wealth and asset distribution, the how, the who, and what to give. What are the various instruments and tools that are actually involved in this process over here? Okay, so when you're saved up, you have invested for X number of years, it's time to distribute your wealth, right, to the next generation. So how do we ensure and do it in a proper manner? So this is next week's topic lah. So join me on Sunday 8 p.m. If not, the repeat will be on Tuesdays and Fridays, like as per today lah. All right, so let's move on. Okay, what to invest? So this is just a quick overview of all the most of the common asset classes. I'm not going to go in detail, right? So I've already sent out this summary. I think most of you have received it. So this is just for your own reference. So as you can see, there is a lot, from your cash to your fixed income, which are bonds, equities, unit trusts, so on and so forth. So I've listed down some of the common types, of investment. So even examples over here and certain pros and cons of each asset class. So do look at this list by yourself. If you have any questions, you want to invest in certain things that you don't understand, do feel free to approach me. All right. So today, we will go in details to talk about 3 asset classes. So number 1, we're talking about equities. So basically, a lot of people here, equities, stocks, shares, basically they all mean the same thing, and with that, right, a share is basically owning a part of a company or part of a financial instrument. Okay, so very common shares market, people invest in Singapore is of course Singapore market, we have Hong Kong, we have US. So some brokerages include London and Japan. So depending on your brokering, the brokerage you are using, right? So fees and charges, very typical, $10 to $25 per trade. So like personally for myself, currently I'm using UOB is $25 per trade. Okay, the idea of this is the higher the trade amount, anything that's lesser than 50,000, right? Your lower the fees it will be because it's a fixed amount, right? $50 in, sorry, $50 for a buy and sell transaction. So if I invest $5,000, my fee is 1%. If I invest $10,000, my fee is 0.5%. So it's very, very simple math over here. So just take note, don't invest in the minimal. If you invest $1,000, right, the cost will be very high, right? So it doesn't really make sense, okay? So how does this shares market work? So a lot of people who are new to buying and selling shares will ask me, okay, so basically in your brokerage system itself, right, there will be a queue system. Okay, why? Because the number of shares circulating in the whole market, right, is actually limited. So when you are buying shares, right, actually you're buying from someone else that actually own the share. So what you do is you enter a bid price or a buy price that you are willing to pay for this particular share. And once the system matches you with another seller, your transaction would have been completed or failed. Okay. So one thing to take note is high volume shares tend to be more liquid, more people are buying and more people are selling. So just to take note, all right? So with that, the second asset class I'll go in detail today is unit trusts and ETFs. So unit trusts are basically a pool of money from investors managed by a fund manager to produce a return and the financial objective of the particular fund or ETF. Okay. So unlike shares, right, unit trusts and ETFs, we have access to most countries or even to specific sectors or industries that you're investing. And of course, we have able to invest in different various asset classes. So shares are being equities by itself, but unit trusts can have equities as underlying, they can have bonds as underlying, or even commodities as well. Okay, so it's more widespread and more access to different markets, right? So the platforms, I'm sure there's many platforms out there. There's Philips, there's even UOB here and things like that. There's a lot of platforms, but personally for our site, GGFA and myself, we are using this iFast platform under Fund Supermart. So charges, as per shown over here, 1 to 2%. So it's based on a percentage rather than a fixed flat fee, all right? Okay, the biggest difference between unit trusts, ETFs compared to equities is unit trusts and ETFs are a collective pool of investments. So there's no quantity limit on how much, are there circulating. So the more money, more people buying into this particular unit trust, for example, right, you just create more units with a bigger pool over there. So there's no quantity limit, can be purchased anytime, right? And of course, last but not least over here, I'll touch a bit on this investment-linked policies. They are basically a combination of traditional life insurance plus the returns of unit trust investments. Okay, so it's the best of both worlds, hybrid kind of product, right? Okay, the reason why I'm talking about this because a lot of my clients actually own this policy, so I think now is a good time to show you some performance update and how this thing actually works. All right. So with that, let's move into details. Let's move at understanding how the market actually works. So as you can see over here, we have 2 charts. The first one being the S&P 500. So basically S&P 500 tracks the performance of 500 large cap companies in the US. And large cap actually refers to at least $10 billion in market capitalization. Okay, so it is a benchmark to show the overall market performance around the world. So and a lot of investors or investments are being compared to this. Okay, so the chart on the right shows the STI index, which stands for Straits Times Index. So it's a similar thing, except we only track for the top 30 companies in Singapore. It shows the local market performance. So as you can see, both charts, prior to COVID and now, right, dropped a good close to about 30%. So there's a slight recovery as of since last week. So I think, okay, so but what does this actually mean to you? When the whole market drops big time, what's your thought process? When a lot of people say, markets are down, right? Okay, is it time to sell off any investments that you're holding to cut losses? Are you pretty neutral? I'm not an investor, so I don't really care about what this thing is about. Or is it time to go on a shopping spree? So I like to use this term. So of course, today, I'm here to tell you why now is the best time, or one of the very good time to start investing. If you're not done so, and if you're an investor, it is a time to, go shopping spree. So personally for myself, I did a lot of investments for the past, in fact, 1 month. So yeah, for those who want to know what I'm investing, just can text me or PM me myself, right? Okay. So the good news is, same two charts, S&P and STI index, if the difference is these two charts are brought to a much longer time frame, back to the 1980s to now, right? The good news is, right, since all the previous financial crises, be it from your SARS, your Asian financial crisis, your tech bubble, you have 9/11, okay, the good news is markets will definitely recover. So if you look at all the red color circles over here, these are the drops over here, right? So after that, you see what happened is it will definitely bounce back. Okay, so it moves in a wave pattern, right? You will go up, you go down, you go up, you go down. So now what you're experiencing here is a very big down. I think it's a very good time, as mentioned earlier, since we know that it will definitely recover. Why not take this opportunity to get in the market, start investing and make some quick cash. Markets will definitely recover, as I said. So sentiments are very poor now, but definitely you will match back to the fundamentals that we are investing. So for example, if you're investing in DBS, right, DBS is very low now. Fundamentally, DBS is a very strong company, of course, to invest in. It's our national bank. It will definitely bounce back up. So the question is, whether are you on board this thing, right? So this is a news article from last Saturday's Business Times. So what it basically shows over here is from the 1980s to now, what are the various financial downturn that happened. Okay, so if you can look at the red circle box over here, right, the recovery time from the trough meaning to say the bottom of the market, right, to full recovery for the last two crises, right, it took about 12 and 13 months, about a year to reach back to the top. And they produced each about 20% in returns. So that's why I say now, we are approaching the bottom. Are we going lower? Honestly, nobody knows for sure. But I think now is a pretty decent time to consider, or getting more, investments into a portfolio. Right? All right. So now that we know that the markets will surely recover, right, let us understand a bit more about what we can invest, which brings me to my first, my first topic, which is equities. So as mentioned earlier, right, equity is a share of a single unit of ownership in a company or financial asset. Okay. So as mentioned earlier, this is DBS. Let's just to put an example over here, right? The chart on the left shows the past 6 months, and the chart on the right, shows the overall picture since DBS is listed, right? So DBS dropped more than 30% the past, in fact, 3 months, but same thing as mentioned earlier, right? Once the market recover, it will definitely recover. It will go back up to where previously it was trading, which is about $24, $25, right? Okay, so this is it will definitely recover. So the question is whether are you on board to catch this? And the question a lot of clients actually post me is what share is there to buy? SGX lists more than 600 shares. In the US, there's more than 5,000 shares. In Hong Kong, we have London, we have Japan. So what are things to research for? Okay, I'll come to this question shortly. But before that, let me talk a bit about the pros and cons in investing in equities, right? Pros is, of course, capital appreciation is definitely there. If you invest in DBS, for example, you definitely go up to make that 20-30%. It's low cost, it's easy to transact, and you have many choices. Okay, but the biggest downside in investing in equity, right, is too narrowly focused. Meaning to say you are just investing in one particular single company. If the company doesn't perform, The price goes up, you're happy. If the price goes down the next day, you feel very anxious, very sad, very kanchiong, you affect your day. So emotional roller coaster, right? Okay, it's very time costly to research. As I said, even in the Singapore market, you have to research 600 shares. I think it's not very easy to do that. And you're facing a lot of professional competition. So from your bankers, your brokers, the investment consultants that the bank actually support the RMs with. So you're basing your own research to a team of professional people. So that might be a tough decision also. And of course, many choices will lead to too many choices, right? So this is a problem about equities, right? Okay, so the question is it risky to invest in a single company? A very short answer is yes, which is why this is my first idea or strategy for the day, when we are doing investments, right? Do diversify, diversify in terms of investing in different asset classes, different countries, or different sectors. So if you are looking at diversifying in equities, right? This is an example portfolio. Okay, so if you look at it, I have DBS, Singtel, CapitaLand, and this Singapore Press Holdings, each in different various asset sizes. Okay, so the reason why diversification works because some companies are more resilient, some are slower to react, some recover faster. Okay, so when such a situation such as COVID, gets affected, right? Some companies will react faster, some slower, some will recover faster. Like now, DBS is back to about close to $20, so I think we are en route to recovery, Okay, the problem with this is it will be very costly to invest equities and to have a diversified portfolio. So for example, this sample portfolio here, right, as of now, I think it will cost you about $9 to close to about $10,000 for a diversified equities portfolio. Okay, so which is why so the question is, a lot of people ask me, is there a way to own a diversified portfolio but at a lower cost? The answer is of course yes, which brings me to my next investment, which is unit trust and equities. So as defined over here, unit trust is composed of a pool of money from investors managed by a fund manager. Okay, whereas the ETF tracks and replicate a specific index, such as stock index or commodity index, of course, to provide a return for you, right? Okay, so unit trusts are diversified, yet at the same time they are very actively managed. Okay, what do I mean by that? So two examples of unit trusts over here. One is the Lion Global Singapore Dividend Fund. Okay, let me talk a bit about this. So Lion Global, right, for the year-to-date performance, right, they dropped about 22%. One of the underlying inside this particular fund, right, is DBS shares. So DBS actually dropped more than 30%, from the past 3 months, right? But for unit trust product, right, it actually suffers a lower drop. Reason is because it's more actively managed, and so it's less volatile to market movements. So if you look at the second one, which is the First State Dividend Advantage, this is a very popular fund that pays a very decent dividend on a quarterly basis, right? It's a global share, so it's a global unit trust, very diversified, in companies such as Taiwan Semiconductor, OCBC, we have AIA, we have Tata. So it's a very global, with more than 10 countries inside this particular fund. So if you realize, as the fund get more diversified and more actively managed, right, the drop is not as huge as a single share. So 13% for First State for the past year-to-date performance, right? Okay, so basically what this means to you that now the equity, the unit trust prices are lower, assuming the dividend amount remains the same, right? Actually, that equates to a higher yield for you as an investor. Okay, and IFAS has more than 600 unit trusts and more than 50 ETFs to suit a different risk appetite for investors, right? Okay, so still on the topic of unit trust, but this is actually a bond-based unit trust. The difference between these and the previous, all other, equity-based performance over here, right? So bonds are very resilient in bear markets or in any market conditions. So if you look at these three bonds over here, Lion Global Asia Bond, Singapore Fixed Income, and this Schroders Fixed Income Fund, okay, they all managed to stay afloat amidst this whole COVID situation, and the Singapore Fixed Income Fund actually made as much as 3%. Okay. So this is a very good example of when you diversify your portfolio into certain things, the different products react differently and you get a different result. So if you can see a normal equity fund drop about 30% as for DBS shares, so everything will drop, but this bond fund managed to stay afloat. Okay, which brings me to my second strategy, like, if you're holding to any unit trust, in an event of, upcoming unstable market conditions, right, do switch over to bond funds so that your investment value will retain, and at the same time, you will remain invested, even at a slower rate. You will not suffer that 30%, 20% drop, but instead you are still positive that 1 to 3%. I think that's very happy to know, if during a crisis your investments are still making money instead of, as per everyone else, suffer a big drop, right? So for very risk-averse investors, I think bond unit trust can be used as your core investments, meaning to say your base or the bulk of your investments. So I'll come to this core and satellite investment later on, right? Okay. So same thing, just to make some advertisement, iFast, we can start investing for as low as $1,000, or for people who prefer a monthly savings policy type, $200 per month for regular premium. So this is a very affordable way, I think, to start investing, right? So pros and cons. So as mentioned earlier, unit trusts and ETFs are very diversified portfolio. They are professionally managed. They are very actively managed, and it's fast to react, so they don't suffer that big drop. Less volatile, pretty easy to transact as well, and you have wide access to markets. And for people who do regular investing, right, you dollar cost average your investment so that your entire portfolio is more less volatile. Okay, so the cons is, of course, active management comes with high fees, so, and you have no control over how this fund manager manages this particular pool of money, right? Okay, so strategy number 3, because of the diversification and for unit trust and ETFs, right, I think it's very good to create investment portfolio just based on this two instruments over here, unit trust and ETFs, right, to suit all investment types. Okay, so let me talk a bit about this core and satellite portfolio to create this, right? So for example, if you can look at the light blue portion of the bigger chart over here, right? If I'm a very risk-averse investor, right, I want my core to be very stable regardless of market condition. I don't want to monitor so much. I put everything in this, half of my portfolio in this bond fund. Okay, as mentioned, regardless of market good or bad, I will still be positive. So my cash flow my liquidity is always there. Okay. Number 2, I can put my second core, the darker blue portion, right, into something that pays a higher dividend, maybe a higher risk instrument like first state dividend advantage, for example, so that I can receive, dividends payout on a quarterly basis. And if you look at the green color one, this is what I call the satellite portfolio. So the satellite one, right, is a smaller chunk in your portfolio that you're invested, okay, but you can actually take a higher risk. So for example, this green color portion consists of China and STI ETF. So these two are very high risk product, but you feel that there's a potential because China is recovering. Their working capacity is back to almost 100%. So you feel that if China is en route to recovery, right, I can actually put a smaller amount of money there to invest there. So when the market recovers back to normal and China actually goes back up, then the capital appreciation of about 20-30% might be realized over there. Okay, so it's very good, it's very important to start to identify what are your core investments, what are certain allocate some amount to take something that's higher risk as your satellite investments. All right. Okay, let me drink some water first. Okay, investment link policies. So what are ILP policies? A lot of negative connotation to this product, but I think personally I feel that it's okay because it is a combination of life insurance plus investment returns. So I think it's for a lazy person like myself, I think this is something that is a very easy way to accept. So this is one example of illustration by one of my clients. This policy was sold in 2009, one of my first few policies. So the policy is going to the 11th year, so 10 plus years. So as you can see, based on the projection, when we signed this document 10 over years ago, right, the projected value is 13,000 to 16,000. Okay. So of course, when I'm back in the days, right, when you show a client such an instrument, right, they say, don't know can hit or not, right? The good news is if you look at the performance or the financials today, policy is 10 years and 6 months. The value is as of today is about 13,000. Okay, this is actually after a 30% drop in the 3 underlying unit trust investment that this policy is holding. So if you calculate back, right, if everything recovers back to normal, the value is about 17,000. So I think I think it's pretty okay lah. So far so good, and I think G is doing the funds are doing pretty decent, and so that for clients who are investing in the longer term, right, this is a very very safe way, or very lazy or very convenient way lah, to invest and get yourself insured, with a higher sum assured lah, right? Okay. So pros and cons, pros is a hybrid product, as mentioned earlier, is a very convenient way, with insurance and investments. Same thing, very diversified, professionally managed, okay, and you dollar cost average lah. So basically, you keep paying your premiums on a monthly or annual basis, so you average down the price of things. Okay, the cons of investment-linked policies, the biggest one is there's an increasing insurance charges. So unlike traditional policies, when you buy in, right, the cost is fixed. Okay, investment-linked policies increases your insurance charge every single year. Okay, so do check with your financial consultant if I'm not sure about this thing, or you can check with me, right? So of course, best of both worlds, insurance coverage plus investment returns. Volatility is lower, because with dollar cost averaging in place, which I'll talk about this concept later, shortly. Yeah, of course, now Great Eastern offers two kinds of ILP. One with the critical illness coverage that includes early stage CI. The other one is investments 100% allocated to investments. So the reason why GE has such a plan, or rather for an investor, right, why would I buy investments from Great Eastern and not directly through a bank or through iFast, for example, right? So to attract people to invest in the insurance company, they actually have to give more special features or bonuses lah. So for example, this Great Wealth Advantage over here, right, they give a welcome bonus of 5%. So meaning you say, if you invest $10,000 today, right, you gain extra 5% on top of that. So that's a welcome bonus. And there's a loyalty bonus, meaning you say if you keep this investment-linked policy for more than 10 years, they give you another 5%. So pros and cons to everything lah, but this is something that the insurance company have to come up with, to attract people to invest with the insurance company instead of buying a fund directly, right? So everyone has a different point of view on this. I think suit different people with different risk appetite lah. All right. Okay, so coming to about 3/4 through, so bear with me for a while more. So what is the dollar cost averaging? So a lot of people, you might have heard of this thing before. You might have know roughly how it works, right? So today, let me just clear the air. So it is actually an investment tool or strategy, right, to build up investment portfolio over time. What you're actually doing is you're investing a fixed amount regularly, regardless of price, be it high or low, or you can actually divide up an investment, lump sum investment, into smaller investments of equal amount and spread it over a regular, interval period of time. Okay, it's a very disciplined and, of course, unemotional way of doing things. The idea and the objective of this is to reduce the overall impact of volatility on pricing. Okay, why? Because nobody can predict the best time or the best price to invest, right? So it removes the the time required to do research, attempting to time the market. Honestly, nobody can time the market lah. Nobody will tell you where is the lowest point and where is the highest you sell, right? Okay, so we avoid mistakes like this when you do a dollar cost average in your investments. So this strategy can be used in all types of investments, not just investment policies. You can do it for your shares, for your unit trust, for your ETFs. So end day, your investment risk is being smoothed out across this investment period, right? Good. Let me just show you a quick example. Okay, so three scenarios here. So same thing, we are back to DBS shares for now. So before this whole COVID thing, right, DBS is about $24, $25. Now it's about now it's about $19 going $20, right? So assuming you want to invest $20,000, in DBS shares today. If I invested $20,000 at $18 per share, right, I will own about 1,100 shares. Okay, so of course the target selling price is when everything reverts back to normal, $24. Then I'll sell off. So based on this, you make about $6,000. I think that's pretty decent sum. Okay, scenario 2, because now the fact is we don't know the market, is it going up or going down, but assuming the market is going down, okay, every 10% for every single week for the next 4 weeks, So same thing, I have 20,000. Instead of putting all today, I'll split the amount up into 5 times. The first time I'll invest 10,000 to buy at $18. The following week, the price drops by 10%, I'll buy in 2005. So same thing for second, third, and fourth week. Okay. So what happens end of the day, if you realize, right, if I'm trying to sell this, let's say on the fifth week, right, everything recovers back, to sell at $24, right? I own much more units compared to if I were to invest, one lump sum earlier. All right. So as mentioned, right, when during a uncertain market condition or unstable market condition, right, things are moving up and down. So I think this is a very good way to mitigate that risk. Okay, of course, scenario 3 is it's an upward trending market. The price goes up by 10% every single week. So same thing, I buy 10,000 at $18. The next week, I'll buy a smaller amount at a higher price. And the third week, same thing, the price goes up, I buy. The fourth and fifth week, right, the third and fourth week, I will stop buying because the share price is very near my selling price. So I actually skip that and keep the capital. Okay, of course, based on this scenario over here, you actually own lesser units compared to as per when you invested at 20,000 upfront, right? Okay, but if you realize the dollar value, right, is not too far off. Okay, so end day, I feel that this, be it a upward trending market or downward trending market, or most of the time it's just up and down, right? If you invest at a regular interval, the same amount of money, end day in a spread it over a longer term, you will be better off. Okay, so this is how actually dollar cost averaging put in the picture, looks like, right? Okay, we're coming to an end very soon. So as mentioned earlier, right, these are some of the key takeaways and to sum things up, right? Strategy number 1, diversify your portfolio, your investments. So spread out to different asset classes, different countries, or even different sectors, right? That's the 1. Number 2, using ETFs and unit trusts, right, to create your core investment portfolio because they are very diversified. They have different types to suit different risk appetite of investors. You can use that as your core investments. And of course, switching over to bond funds, during very unstable market. So iFast offers this thing called a wrap account. Wrap as in WRAP, right? Wrap account allows clients to do fund switching within unit trust, right? That is free of charge. So you pay a flat fee per year. You can do fund switching as much as you can, and you don't need to pay the upfront sales charge again, right? So for shares and ETFs, we can't do that, right? So that's just for bond funds. And of course, last but not least, dollar cost average your investments, be it you're investing in equities, unit trusts, ETFs. Yeah, I think dollar cost averaging is a very safe and sound way to manage and build up a portfolio over time, right? Okay, so hopefully, with today's session, right, everyone is more, understand this thing a bit more. You are more ready to invest. So if your wealth protection is done, your cash flow, your budgeting is done, right, with a slightly better understanding, I hope, you can start invest. Okay. So a lot, sometimes people ask me this question, what is the exit strategy for investments? So of course, there's 2 parts. Number 1 is, when you have set up, when you have right from the start, you have set a financial goal, to fulfill your kids' education, or, use it for your house down payment, right, or second house down payment, right? If you have achieved that, then yeah, good for us, good for you, right? You have achieved your financial goal. And number 2 is, as we approach retirement, right, our risk appetite will get lower. And what we'll do over here is we will move, partially, part by part, your investments to something that's less volatile and it pays a dividend, so that this actually can create a passive income stream for you, so we can hold these investments till the day we pass on, and we can pass on these investments to the next generation, which can benefit from what you have created, for the past 20, 30 years. So investments doesn't stop at a person's demise. I think you just continue, pass it on. If the next generation can handle it properly, right, we can have actually continued income stream for that particular person inheriting it, right? Okay, I think this is my last slide. So an action plan, because the previous round, people say, I'm not sure what can I get into. So for investments, right, we always categorize into your risk appetite. So from a low to medium risk appetite to medium to high, of course, we have a very high risk investor. So let us look at the middle column over here, right? Okay, as mentioned earlier, the core 1 and core 2 normally are the more stable funds that gives a pretty decent dividend. So for example, 2 examples over here. First State Dividend Advantage pays about 4.3% dividend, and First State Bridge, which is a lower risk asset class, pay a slightly lower dividend. Okay, so both funds are equally, the track record has been very good. And now the both prices are much lower, about 20+% lower than as per normal. So I think this is a good time to start investing. And of course, satellite 1, satellite 2 refers to slightly higher risk product. So for example, Singapore dividend equity right now is down by about 30%. So gives a dividend, quarterly dividend as well. But if the market recovers, the capital appreciation of that 20/30% might be there. So this is, I think, a very good time for us to catch and grab this opportunity. Like, it doesn't come very often. All right. Okay. With that, I think that is the end of my presentation. Hope you learned something from this. Okay. If anyone has any questions, please feel free to text me or use the chat box. If not, some of the questions I've gotten from previous sessions. Number one, what is a wrap account? So I briefly mentioned that earlier. So for wrap account over here, right, for iFast Unit Trust, right, what we do is it allows you to do unlimited free fund switching. So you pay a 1% charge, you get to switch from equity funds to bond funds, back to equities, without incurring any additional sales charges, right? So that's one thing. Number two is what questions did I gotten the last time? Okay, I can't remember any anyway. So anyway, if you guys have any questions regarding to any type of asset investments, right, do drop me a text, drop me a WhatsApp message or even email, right? So we'll try to solve. Okay, what platforms can we invest in? Okay, for what platforms can we invest on? One of the questions that came in, right? Okay. Currently for myself, if you're talking about from a Great Eastern perspective, right, we are using iFast purely for investments. So 600 over unit trust, we have over 50 ETFs that we can choose and select for clients, right? So I hope that answered the question, right? Okay, with that, if there's no more questions, yeah, so this is my last slide. So this is my third session for investments. The next webinar will be on asset distribution. So your wills, nominations, trust, LPA, things like that will come into the picture. So I will try to make it not as dry, I guess, I hope. But do join me on Sunday, 8 p.m. This coming Sunday, 8 p.m. That will be my first session. And yeah, so there's that. The repeat will be on Tuesday and Fridays subsequently. I think 1 p.m. is a pretty okay time because previously we tried 12:30 p.m. The response is not that good. So lunchtime talk, we have lesser crowd. So I'm trying to fine tune that. So we thought 3 p.m. is a good idea initially, but I thought most of people will be still working from home. So we don't want to interrupt that schedule, right? Okay. With that, yes, next webinar over here, to join me on Sunday, right? To have some basic understanding of ISA, what's nomination, do I need a will, right? And of course, do like and share my Facebook page. I have a personal financial planning website as well called On Point Financial. These are examples of what we do for clients on a more in-depth level. So we calculate a lot of financial ratios. We look at cash flow analysis, so things like that. Do drop by the website to check it out. Of course, if you have any questions, do WhatsApp me or call me or email me, right? And some of the videos, I'm trying to put this up on YouTube or Facebook. So if you have friends that you feel that is beneficial, right, get them to join the live session. But if not, right, do check out the Facebook and YouTube links after that, right? So with that, I think, yes, that's the end for today's session. I hope everyone learned something. Of course. So some of the feedback given, if any feedback, please do let me know. So one of the feedback previously from previous sessions is, oh, this is actually very basic stuff. I already know that. So I think as a financial consultant myself, right, my job is not a investment specialist. I guess, my job is to educate people how to get into investing. How do you get started? What are the basics? Of course, you are personally very into investing, right? YouTube has a tons of videos. Like for example, Adam Khoo videos are very good, for the higher level, middle to higher level investments or investors. So do check him out. I think I follow him quite a fair bit. So I think yes. All right. With that, thank you everyone. So weekend is coming soon, so I think let's enjoy the weekend for now, right? Okay, Ken, thank you very much. Thank you for your time, everybody. Like and share. All right. Okay, thank you.